Hi, I'm Anthony Diosdi from Diosdi Ching Liu. Today we'll be talking about Schedule J to Form 5471. Schedule J is used to track the earnings and profits of a controlled foreign corporation. Individuals can be classified as filers 1, 4, and 5 need to go ahead and prepare a Schedule J and attach it to their Form 5471. The form begins fairly easily and self-explanatory, and it basically asks the individual who the form is being prepared for, or the individuals preparing the form, the name of the filer, and the EIN number of the foreign corporation. But things get a little more complicated as we move down the form. The form begins fairly simply and just asks the preparer to list his name on the form and the EIN number to the foreign corporation. Under the filer's name, you're going to see a letter A. And next to the letter A, you'll see a statement which says separate code. That separate code itself, that line, asks you to go ahead and classify the income that's going to be reported on the Schedule J in certain codes. Unfortunately, the Form 5471 does not state the codes itself that needs to be stated in that area of the form. Instead, you have to go ahead and look at Form 1118, and that form itself will state the code sections for the particular income itself that needs to be disclosed on the form. Underneath the letter A, there's going to be a letter B, and that actually talks about sanctioned countries. So if the controlled foreign corporation is conducting business in a so-called sanctioned country, that's a country that the U.S. has enacted some embargo or boycott provisions against. That box itself will need to be checked, or that box itself next to line B will need to be indicated to the IRS that corporation itself is conducting business in a so-called sanctioned country. Now move on to Part 1 of the Schedule J. And Part 1 is entitled Accumulated Earnings E&P of the corporation. Under Part 1, there's going to be a box that needs to be checked. And the box itself should be checked if you do not have all the information for all the shareholders of the foreign corporation. If you do not have all the information necessary to prepare the Form 5471 Schedule J accurately, this box should be checked. Next, we'll move on to the actual Part 1 schedule of the form. The form itself has a number of columns that ask to prepare a number of questions. Let's start with column A on the form itself. Column A talks about post-2017 untaxed income. So basically, any type of items of income itself that have not been previously taxed of the controlled foreign corporation needs to be disclosed under this column. An example of previously taxed income might be high tax exemption subpart F income, or maybe in certain cases, Section 965 income. That type of income itself will need to be disclosed under column A to Schedule J. Next column is Part B. Part B talks about post-1986 undistributed income. Now, understand, if you're preparing the Form 5471, if you're going to go ahead and prepare this column correctly, you need to understand how post-1986 income was taxed, because it was taxed and disclosed on a Form 5471 differently. And this kind of goes into accumulated earnings. And when you're talking about income that was earned by a foreign corporation post-1986, it was all about pools. Basically, you had certain pools of income. And the problem is that after 1986, the law changed a number of times. So at one point you had 6 different pools, another point you had a little bit more, another point you had a little bit less. So you really kind of have to understand the pooling rules to the Internal Revenue Code, and those are discussed in Code Section 902. But in any event, that's kind of a tax accounting type of a concept. But you need to understand that tax accounting process in order to go ahead and make a disclosure on the Form 5471 Schedule J for tax accounting purposes and disclosing income that has not been previously distributed to the shareholders of a controlled foreign corporation. We'll now move to column C. Column C talks about pre-1987 untaxed distributions of the foreign corporation to the shareholders. Now, after 1987, or I should say after December 31st of 1986, the way things were taxed as far as undistributed foreign source income, as I mentioned before, is talking about pools. But prior to that, you had basically waves. Everything was kind of taxed in waves per year. It wasn't broken down in pools. But the problem is, prior to the 1987 tax year, you have to keep really good records to go ahead and track an item of income that has not been distributed to a foreign corporation. So hopefully you're not having a situation where you have to deal with this with a client, or you don't have a situation on your Schedule J, you have to deal with this. But if you do, pay very particular attention to the regulations and the case law that was enacted under the Internal Revenue Code prior to December 31st, 1986. The next column we're talking about is column D, the Schedule J. Column D asks you to list the hovering deficits or the splitter rules or the splitter types of distributions on the Schedule J. Well, what is a hovering deficit? Well, hovering deficit applies when you have a domestic or a foreign corporation, I should say a controlled foreign corporation, that acquires another foreign corporation or the assets of another foreign corporation. Now, what tends to happen sometimes in these type of cross-border merger or asset acquisition transactions is that the assets or the corporation itself that's being acquired has so-called built-in losses. And those built-in losses are what triggers the so-called hovering deficit rule. And what the hovering deficit rule prevents an acquiring controlled foreign corporation from doing is that it does not allow the controlled foreign corporation from taking the losses of the acquired foreign corporation or the losses built into an asset for previous tax years. Now, that sounds really easy in concept, but unfortunately in actual tax rules, it becomes really complicated, particularly when we're talking about reporting the transactions prior to the 2017 tax year. And prior to 2017 tax year, there was a number of different pooling or baskets that had to be gone ahead and enacted to classify certain losses, such as passive or ordinary, for purposes of carrying forward the losses until they could be used by the controlled foreign corporation. Now, things get a little bit more complicated for tax years 2017 going forward, because as of this date, the Internal Revenue Service has not promulgated any regulations which give us any kind of good guidance as to how to go ahead and disclose a loss, a built-in loss of an acquired asset or acquired foreign corporation. So this is something that whoever's preparing the form should have a strong idea on how to go ahead and make a disclosure on the Schedule J. Now, column D also asks the preparer or the individual who's the tax return to be prepared on account of to disclose any kind of suspended taxes. So the question is, well, what is a suspended tax? Well, a suspended tax triggers the technical taxpayer rule. And what the technical taxpayer rule talks about is if you have a splitting event. A splitting event is when you have a controlled foreign corporation that somehow in its books it has a foreign tax that was paid. However, the controlled foreign corporation itself was not technically liable to pay those taxes. If this should take place, although the tax itself that the technical taxpayer rule kind of kicks in for doesn't allow deduction for the controlled foreign corporation, however, it should be disclosed on the Schedule J. It'll be disclosed on Schedule J under column D. Okay, now we're going to move on to column E. Column E itself has a number of separate subcolumns that are involved on the Schedule J. Now, in order for you to go ahead and accurately report the columns in Schedule J and do it properly, you have to know something about Code Section 959. 959 allocates items of income that has already been taxed. And column E is all about disclosing items of income that have already been taxed. Now keep in mind that a lot of times a foreign corporation will make a distribution to the shareholders that's taxable to the shareholders of the foreign corporation. However, the shareholders actually never received any kind of money from the company. And this kind of takes into consideration such situations of subpart F income distributions, or when the foreign corporation itself invests in U.S. property. Now, unfortunately, there are no regulations that the IRS has promulgated yet for Code Section 959. The only type of indication that we have for the ordering rules comes in the form of a notice that the IRS issued in 2019. It's IRS Notice 2019-01. 2019-01 talks about the ordering rules of a controlled foreign corporation. And basically, anybody who's preparing a Schedule J really needs to go ahead and review Notice 219-01 to understand how to go ahead and place the sources of income that has already been taxed to the shareholders of the foreign corporation, and what columns itself the items of income need to be disclosed under. Now, after reviewing Notice 2019-01 and going through the ordering rules, there might be one area that still might be confusing that's listed on the Schedule J, and that's the excess passive assets column under column E. It's nothing to worry about. This is kind of a 1990s thing. It was really enacted for large multinational companies that were investing in certain types of passive activities. It's only around for a couple of years. It only really applied to large foreign corporations. So the chances of you seeing this or actually have to apply this in real life is fairly minimal. Now, the next column is going to be column F, and column F is basically going to ask you to add up the columns that we discussed earlier. Okay, now since we went across the columns on the Schedule J, let's move down the form itself. Let's go through the questions that are stated on the Schedule J. Question 1A asks for the beginning balance for each column. Question 1B asks for the beginning of the year balance with any adjustments. If there are any type of adjustments that should be disclosed to the IRS, an attachment should be attached to the Schedule J of the Form 5471. Be careful with this part, because if it's not done, the Form 5471 Schedule J, and along with the entire Form 5471, will not be prepared correctly, and you'll be subject to the harsh penalties of not filing a correct Form 5471 with the Internal Revenue Service. Question 1C asks you to add together Question 1A and 1B. Question 2A asks about the anti-splitter rules. Now, the anti-splitter rules is what we just talked about earlier when it comes time for the technical taxpayer rule. But this is a situation where you may have a foreign tax that's on the books of the controlled foreign corporation. However, the foreign corporation itself was not legally liable to pay that tax. Although it will be on the books of the foreign corporation, there will not be a tax credit that will follow. Question 2B asks you to back out any type of disallowed foreign tax credits under the technical taxpayer rule or under the anti-splitter rules. Question 3 asks you to list the current foreign corporation's E&P or deficit in the foreign corporation's E&P. Question 4 asks you to list the E&P for an associated tiered corporation. So if you have more than one E&P, because you have multiple corporations, question 4 will ask you to take this into consideration and file the appropriate E&P for purposes of disclosure with the IRS. Question 5A asks you to go ahead and adjust the E&P to take into consideration any non-recognized transactions. Now, Question 5B kind of clarifies Question 5A because it talks about hovering deficits and non-recognized transactions. So if you have a hovering deficit from the acquisition of a foreign corporation or foreign assets, this is where you go ahead and list it for purposes of disclosure to the Internal Revenue Service. This would be under 5B, whereas 5A, if there's a non-recognition transaction not involving a hovering deficit, it'll be listed on Question 5A. Question 6 talks about any type of other adjustments. And if there's any type of other adjustments, that should be disclosed on an attached statement. Question 7 asks you to add together lines 1C through line 6. Line 8 of Schedule J talks about a transition from Code Section 959C2 to 959C3. In order for you to kind of fill this part of the format or understand how to answer question 8, you have to understand something about the ordering rules of Code Section 959. There are 3 different categories for purposes of the ordering rules of 959. There's 959C1, 959C2, and 959C3. And what is being asked of you here is when you're having an item that's already been disclosed on the return for Code Section 959C2, which moves to 959C3. It's an important move because when you're moving something from 959C2 to 959C3, it may become a taxable event. Line 9 talks about an actual distribution. And that brings us back to question 8, when we talked about an item of income being moved, which has supposedly already been taxed from 959C2 to 959C3. If there's an actual distribution because of the ordering rules, you would disclose that on line 9. Line 10 talks about 959 again. Now, line 10 talks about the ordering rules and how you have a reclassification from 959C1 to 959C2. Now, understand the ordering rules is all about disclosing or reporting to the IRS items of income that's already been taxed. But what happens is when you have an item of income that's already been taxed or a specific item of income that's already been taxed, it gets moved. As the company itself continues to have additional transactions that have already been taxed, you will sometimes get reclassifications from line, or should I say Code Section 959C1 to 959C2. So for purposes of making disclosure to the IRS, line 10 is when you make that disclosure to the IRS, when you actually have a movement from 959C1 to 959C2. Line 11 is where a disclosure is made for an item of income that's already been taxed, and that item of income could be traced to investments into U.S. property. Line 12 is for other adjustments, and that would be for other adjustments that would take place according to the ordering rules that the form itself does not disclose. If there's something else that impacts the ordering rules, an attachment should be made to the tax return. If the attachment itself is not made to Form 5471, once again, the form itself would be prepared incorrectly and could subject to preparative penalties. Line 13 talks about the hovering deficit rules. Now, earlier we talked about the hovering deficit rules, and we spoke about the fact that when you have an asset or a corporation that's acquired, many times there's a built-in loss, so to speak. Well, that built-in loss could result in an offsetting of certain items of income to the controlled foreign corporation that acquired the entity itself. Well, line 13 takes into consideration these situations where you have a loss, a built-in loss from an acquired foreign corporation or a foreign asset, and when that loss itself is used to offset an item of income of the controlled foreign corporation. Line 14 is going to be the beginning balance for the next tax year. That should be listed on line 14 of the Schedule J. That concludes this presentation. I hope that you found this presentation to be helpful in the preparation of the Schedule J for the Form 5471. If you need any help with the preparation of a Schedule J or Form 5471, or need any guidance, feel free to contact us. We can be called at 415-318-3990. Or if you wish, feel free to look us up on our website. That's sftaxcouncil.com. We have over 20 years of experience in international taxation. We hope that we can assist you with your international tax needs.